Welcome to America's Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hello, I am Michael Bull, and I appreciate you being with us. This segment is brought to you by my company, Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com or give me a call personally. Well, we have an interesting show for you today. We're going to talk about the office market. I think the office market is very interesting because it's always been a great class for investors to buy in, both small and large properties. We're also seeing a lot of changes in the way corporations use space. And we're also seeing some changes in the economy. The economy is going strong. But what's happening in the office market? How is it performing? How are sales volumes doing? How are cap rates doing? Also, we're going to talk to some folks and talk about some ways to market office properties. We're going to talk about some technology, so we have a lot in store for you. Please welcome my first guest. This is Jim Costello, and he is Senior VP with Real Capital Analytics, and he's joining us on Skype.
Thank you for having me here.
Oh, yes. Thanks for being with us, Jim. So, Jim, let's talk about the office market. You guys track the office sales volume and cap rates and things very well. What are you seeing? What's the trend?
Yeah, it's great timing. We published a report looking at trends through Q3 last night, and deal volume is up. It's up for the year. The challenge, though, is that there's differences in terms of where transaction activity is happening. Through most of this cycle, since the end of the global financial crisis, investors have really been focused on CBD office activity. That is starting to shift. The deal volume of late has becoming much more focused on suburban areas.
And is that focused on suburban area because they're chasing yield, or is it because maybe there's less CBD product available?
I think there's a few reasons. You've touched on two of them. There is an asset availability issue. So many of the high quality office buildings in CBD locations have transacted in this cycle that there's not enough blood left in the stone to squeeze out for that next investor. And so owners who are holding those now are probably more reticent to sell. There is also an issue, though, of better yield in some of the suburban locations. Cap rates have been squeezed to record lows in most areas, but there's still a little bit more yield on offer in these suburban locations. And then I think there's also, though, a big generational change. One of the first things that started happening in the early part of this cycle was investors looking at these CBD locations with the notion that this is the area where the millennials want to live, work, and play. That's more than 10 years ago where that trend started. And in 10 years, the 20-somethings have become 30-somethings. Some of them are pairing off and having families. And that's when you move to the suburbs. So there's a growing awareness of the fact that the labor force is moving that direction, and that creates activity for investors to take advantage of that trend in suburban locations.
Okay. And of course, the cap rates will change from somewhat quarter to quarter depending what assets actually sell. But what are the trend? Are you seeing cap rates level out? Are they rising? What do you see?
Well, the cap rates in all areas for the office market are somewhat flat at this point, whether you're in the suburban locations or in CBD locations. They have reached record lows. The expectation on the part of many investors is that you can't see so much more of a cap rate decline. The issue here is we're facing a higher interest rate environment. A difference so between the two geographies, I think about suburban locations versus CBD locations, prices have grown more slowly in the last quarter in the CBD locations than in suburban. Suburban locations, a little bit closer to 8% year-over-year price growth versus the low single digits for CBD locations. There's just not as much pressure on the part of buyers being as aggressive at this point to get into these big CBD office towers and bid up the prices.
And overall, when you look at the market, are you seeing good NOI growth at this point?
The NOI figures, that's not something that we track as much. I don't have anything off you there, sorry.
Yeah, but you're tracking the cap rates and you're tracking the prices. So are the prices going up a little bit? You said the cap rates are fairly flat, but are you seeing prices rise some?
Yeah, prices are rising some. The stronger price growth in the suburban locations than in the CBD locations. And you can infer the NOI growth between those by looking at the differences of cap rate trends. Yeah. And so you infer that suburban locations have stronger NOI growth. I don't have that directly measured, though.
And when investors are looking at the different asset classes to allocate funds for, how do they feel about the office sector right now? What's your feel there?
The office sector, one thing that is curious, we've seen for 2018 so far a tremendous amount of portfolio and entity level transactions. It's raising a specter of 2007, where that was also a big driver of the market. That was a big driver of the market to the detriment of the investment market in 2008 to 2010, because investors had piled into the sector with abandon and without cautious underwriting standards. But so today, you have a different type of investor coming in, also doing these big portfolio and entity level deals, but you don't see as much of that for the office sector. That's one area where the office sector is very different from every other property sector. The activity for the office sector is really focused on the acquisitions of one building at a time. In fact, if we go into the suburban locations, when you look at that so-called single asset sale market, where it's one investor buying one building, deal volume there is at a record high level. We've never seen transaction activity involving single asset sales in the office sector as high as it is today. It was definitely not this high back in 2007 when investors were buying anything. That just shows that strength of suburban investor interest.
Yeah. Now, you said you just spent a lot of time in finishing up your third quarter reports for the office sector. So what else did you glean from doing that? What else? What are the other trends you're noticing?
One thing that I find very interesting is the way every market is moving to its own beat. You have, think about the last cycle where you hit a peak on deal volume everywhere, and then everybody went through the same type of drastic decline. Right now, you have some areas that are recovering from their own local economic changes, and others starting to see a slowing in deal volume as investors come to grips with changes in the marketplaces. So for instance, Manhattan, biggest office market in the United States. In 2017, deal volume fell at high double-digit rates. You had a change in market expectations. Chinese investors had started pulling back in 2016 and in 2017. They hadn't bought everything in the market before that, but they had changed the expectation investors had on pricing. And as that class of investors pulled away because of capital controls back in China, the market stalled. Now, however, there's been a slight upward adjustment in cap rates for Manhattan, and that was enough to bring investors off the sideline, and deal volumes rebounding at double-digit rates. Now, we've seen similar kind of investor price reactions in other markets. Let's look at Texas. Texas, you have Dallas and Houston, two biggest markets there, very different trends. Houston, you go back a couple years, everybody was afraid about oil, and deal volume stalled for a while as investors were worried about oil price changes kind of taking the wind out of Houston. The funny thing, though, is that Houston is not the 1970s Houston for oil, and eventually deal volume recovered because investors saw the yield opportunity. But now cap rates are coming back down because everybody has jumped in. They realize that the water's great, and they're seeing some opportunities there. Dallas is different than both of them. with facing that challenge of cap rates coming down, and investors now becoming a little bit more cautious, worrying about what happens next with interest rate increases. So that difference between three big markets like that, it tells me that what we're seeing today is very different from the last market peak, where we hit a peak and everything started to slide. There were common global credit market factors taking the wind out of every market. Today, what's happening to change markets or to continue to drive markets, it's about the strength of the number of bidders active in that city and investor interest in the assets on offer.
Yeah, and that sounds like a more healthy environment, right?
Yeah, definitely. It's not the type of 2007 into 2009. We had a credit crunch underway, and today there are some signs that people get cautious about because they see these large entity level deals overall, and that sets off some warning bells. They see cap rates as low as ever, and that sets off some warning bells. But there's a very deep pool of lenders, and they're doing things at much more cautious levels than they had back in the last cycle.
Yeah, and that's a healthy thing too. So what would you leave our audience with to think about the office sector, Jim?
The office sector, in terms of where investor interest is located, is changing. I can't stress enough, the suburban areas are coming back. Many people had written them off just a few years ago, thinking that everything would be a CBD type focus to the future. But companies follow labor, and labor is focused on the suburbs to an increasing degree at this point, just given the aging of the millennial generation. That's not to say that every office asset is the same. What we're seeing in terms of price recovery is much stronger in those suburban locales that have urban feel to them, a mix of land uses nearby, some walkability features. That old office building at the end of a cul-de-sac with nothing else nearby, where you have to drive everywhere, that's just not getting as much attention.
Right. Yeah, that makes sense. I think we talk about cap rates and things on this show around the country, and obviously every asset's different, and because we quote maybe a 6 cap rate or a 4 cap rate. A lot of these properties, we sell properties that have cap rates from 4 to 12. It's like, wait a minute, on the show you said cap rates for 7. I'm sorry, sir, yours is a 4. Is that okay? Or yours is a 12. No, that's not okay, but I'm sorry, that's what it is, right?
Yeah, quality differences in every building. It's you're not buying a bushel of soybeans here. Every building has its own unique features.
That's right. Well, Jim, thanks for joining us. Great information.
Thank you much.
If you'd like more information from Jim, check him out at Real Capital Analytics. And stay with us. We'll have more on the office market. As promised, we're going to talk about some technology and some marketing. Stay with us. I'm Michael Bull, and this is America's Commercial Real Estate Show.